I think it's been an exciting year for the market. It's been an exciting year and every major front, and it's been a year that is we've seen a great achievement on a national scale. Change of administration. I consider it to be a breath of fresh air. Depends on where you are in the spectrum. You may like it more, you may like it less. But I think a change was absolutely needed, and I think that that's the global scope, not just in the United States. So we're very happy to see those things. We're able to do better with a lot of what's been going on. If you consider inflation, the economy is sort of like, moving in the right direction. Of course, everyone's happy with the numbers when it comes down to employment, and of course, everything is correlated. We see all those things together. We were very quiet in the first part of 2024, right? I want you to envision sort of like a clock, a face of a clock. It's 12 o'clock up, and then we have 6 o'clock. And I want you to envision that this is sort of like how we look sometimes at the market. And the way we see it, right? If you want to look at in sort of like 2021, early 2022, we sort of like, if that was the clock, the market is a clock, we were looking at a market that was sort of like at the hour 11, 10, 11, sort of like peaking at 12 o'clock, I would say, early part of 2022. And then we worked through, we saw the shift that has happened directly correlated to increases of interest rates by the Feds. And we would call that moment in time, which would be March of 2022, sort of like the 12th hour. Knowing full well the correlation between interest rate, knowing full well the correlation and the effect it has on the economy, and of course on real estate, cost of capital goes up, values go down. We started seeing a drop, quite a quick drop, a very, very significant drop. So you might say visually we were at 12 o'clock, Q1 of 2022, and very quickly we've seen a drop. You might want to call it, from 12 to sort of somewhere between 3 to 4 o'clock, right? So think about that for a moment. Now, you don't want to be in a market, in a declining market. Somebody call it or refer to it as the falling knife syndrome. You don't want to be in a falling knife, so you don't want to catch a falling knife, right? You want to let it fall. And so we didn't. And so we've let sort of like a year and a half pass, let the market sort of like create its own new bottom. Conceptually, we believe that early 2024, if you're still like the clock analogy, we're looking at around 4 p.m., 4 o'clock to 5 o'clock, sort of somewhere there, where the major fall has occurred already from 12 o'clock to call it 4 o'clock, 5 o'clock. The major drop has happened, and then we're sort of like looking at a new bottom. Now, we don't know exactly what the absolute bottom is, but all the fundamentals have shown us that everything is pointing towards we're in a very nice and very comfortable button, and arguably starting to reach maybe even the first signs of sort of like an incline. So I would argue we were somewhere between 5 and 6, 4, 5, 6, sort of like when we started going into the market again, which was in the middle of 2024. We felt we reached the bottom. We spoke about it many times. We said, hey, interest rate was 9%, 9.6%. It's now at 3.2, 3.4, sort of like dropping away from that into the twos, right? It's showing us enough of a shift. Construction starts, we noticed, have dropped significantly. Cost of capital started to show us all sorts of signs that, the Feds have stopped with the perpetual increase in interest rate. And so we started to see those opportunities coming back to us, right? The good developers started picking up and showing us projects. And like to say the words of Blackstone, we do our best work in this type of a market. Consider the market itself, right? Consider any market. It's sort of like a phenomena of a 9 to 12 years, sort of like a cycle. And within it, we have three different major cycles. So the first one is sort of like the drop market. That usually takes about kind of like 2 years, 2.5 years, 3 years. Things get repriced opportunities, sort of like, defaults happen, a lot of defaults are happening, that sort of a thing. Lots of opportunities to start new things, to reprice things, to get discounts, if you will. And then going through that cycle, then we go through another sort of like a 3, 4 year type of a period where you'll go from like a 6 climbing all the way up, towards your 7, 8, and 9, right? So that will be sort of like the next 3 years, 3, 4 years. We're somewhere in this mesh between those two cycles, in our opinion, at this point. Now, nobody knows for a fact, and of course, we have to be cautiously optimistic and always keep our fingers on the pulse. But having said all of that, you know, these are the times where, more opportunities are happening, more capital, and I'm talking about that period that I think we're heading into, which will probably be sometime around 2025 into 2026 and 2027, right? Those the next 3 years are very, very promising years in every which front. Yes, there's obviously some risks, and we'll talk about those, but ultimately, this is how we sort of like see where the markets are heading. And ultimately, the euphoria comes after. All right. We believe that sometime around 2027 and onward, there will be less opportunities. Things will again be repriced and repriced probably very aggressively. At that point of the cycle, the market is flushed with cash. Right now, there's not enough cash in the market to get us into that concern. Most of the institutionals, not all, most of the institutionals are on the sidelines. The big money is on the sidelines. The big money, usually the insurance, the pension, the REITs, they usually come in last, and they enter and they exit first, right? So if you think about it, most of the institutions are essentially looking for the safest part of those cycles, right? These are the guys that we sell properties to. They don't take the entrepreneurial risk that we here take, right? They want a stabilized asset. They want us to build. They want to buy it from us at 4.5% yield on cost, right? But they don't want to take the risk. And so when that capital comes in, also met with a moving market and stuff like this, the last part, it's again a market to watch out for, because that's the capital of last year, the 3, the 4 years, where everything is up for sale. Things are really priced, well, I would sometimes call it insanely, with not a lot of common sense around it. And so usually met with a lot of capital that's available in the market. And those are the best years to sort of like sell and exit, right? Now, let's focus on 2024. Alex, you have the.
Try clicking on the screen. I think, yeah, you'll be able to.
Okay, wonderful. So a quick summary of what's going on for those that are new maybe to this conversation. Again, Glassdoor is our opportunity once a month or so to get in touch with our existing investors, investors that are looking into putting capital with us, and just share sort of like our thoughts and our activity over the last 30 days. And of course, to share any breaking news or anything around those lines. But again, as an introduction, Astor is now celebrating, next year we'll be celebrating 5 years, I'm sorry, 10 years. As a collective of the principals, we are 65 years of experience in the world of real estate. Average return on all of our strategies. Average return in all of our strategies generates still today 23.2% return, average return. When I say all the strategies, we have different strategies, the investment in debt, investment in preferred position or mezzanine, and investment in equity. We are now operating in 12 performing markets, right? Some of them we've exited. In fact, most of them we've exited. There's some markets that I don't consider ourselves going to go back to anytime soon. One of them might be Chicago, Illinois. We've done a great project. Some of you here have been with us on this project. There's no reason to come back. We can achieve the same yields without having to pay those every burden, taxes, and extra unnecessary bureaucracies that we found over there. And although it was a great project, I'm giving it as an example, we will not go back to Chicago, Illinois. There's just no need for it. Number of units we built from inception or participation from inception is 3,634. We do that every quarter. We do the count. Overall, in real estate investments that we've taken part of is slightly over $3 billion, 4.58 million square feet, so almost 4.6 million square feet of beautiful, gorgeous, I like to call them gorgeous, sexy buildings in great locations. And from inception, we're managing $150 million. No, I don't have control. Beautiful. All right, just to go a little bit, to dive a little bit deeper into the various strategies. I'm not going to spend too much time on that page. But again, if you look at overall transactions that we made 38 different transactions in the course of the last 9+ years, almost 10 years. Next year will be 10 years. 18 transactions in joint ventures, 13 in preferred, mezzanine were 4, and senior positions were 3. This is how we've invested $150 million, generated out of it $252 million. Obviously, different strategies, different risk factors, and different risk factors, different returns. So if you look at the top right, we're looking at an annual return. Our joint ventures have generated for us 27% annual return, preferred equity 19.5, mezzanine 17.4, and senior position, which for me is a shocker, we're able to generate 15.8. It is a purely first position. How did we manage to do it? Well, we managed to do it because we're simply looking for great yields. And obviously, in certain years where the concept of when there's not enough capital and we're able to put a first position, generate such a high return, for those numbers, we'll take it. The overall, again, is 23.2. Okay, as far as active positions, I think I'll skip that part. It's a little bit too much information. It's all available here. And of course, we will share this presentation so you can dive a little bit deeper. And obviously, any questions that you have for us. But what I am very proud to say is that the bottom part, if you look at, we've exited $59.5 million from inception. Right? So we exited $60 million from inception. By the way, the gorgeous picture on the right is one of our projects located in Scottsdale, in Arizona. Where over there we've teamed up with a local group, and we were the major investor in this project to build 265 keys hotels. That's called the Caesar Republic, the first non-gaming Caesars in the United States. Everybody knows the Caesars in Vegas and the Caesars in Atlantic City, where they got the casino. This is a non-casino, however, the brand. We're now teaming up also with Hilton, and it's going to keep the brand Caesar. Caesars love the brand, but we need the reservation systems of Hilton. It's going to be sort of like a dual brand. It's going to be a very, very unique project. Completed in March 6th of this year, and we're super proud of this property. We underwrote the deal about $167 million stabilized. The appraisal came back and told us that in the appraisal's opinion, which is a big company, it's a CBRE, national, actually global company, that they think that the valuation is much higher than that, $206 million. So do I believe this number? I'd like to, but I don't necessarily agree with it. I think it's a little bit lower, but certainly better than what we've expected. Nice win for all of us and for our investors, of course. Can continue to the next page.
Did you want to try clicking on the screen one more time just to move it?
Let me try.
Okay.
Yeah, good. Something that we've sort of like, kind of like looked at our returns in the last 10 years, and something we're very proud of. We don't have any losses. From 38 transactions, those that are getting from us the quarterly reports, 38 transactions, no losses. Now, it doesn't mean that we didn't have or we don't have some challenging projects that we're working through. We'll talk more about those in a few moments. It doesn't mean that. And so this is why when we speak to you, the investors, and you come to us with a big check, hey, I have this amount of money, I have $1 million to invest, we always say, let's diversify. We are not a fund. Our job, okay, is to find great opportunities and to offer them to ourselves, right? We always invest our own capital to offer it to ourselves and to offer it to our clients, our investors, our friends, our family members, and create a diversification for them. Now, it's a very bespoke type of a situation. The guy with $1 million in this example might like only income deals, right? Might like lower type of risks than, let's say, somebody else. And so the ability of us to offer 6, 8, 10 transactions, I'll call it 6 to 8 transactions a year, obviously provides us the opportunity to speak to different investors and offer them different things, right? We were, I'd say, blessed to offer and to take on transactions, and of course this is a sign of the time, we probably sign up a few other things, to offer transactions where we are able to get very high yields, right? The Joel Schwartz deals, the preferred equity with all the extra stops and bells and whistles, and generate anywhere from 16 to 18% on a quarterly basis to our investors. And so we met with tremendous response, very, very positive response. So we were very much oversubscribed in those deals. I don't expect that those deals will continue generating such high returns, although we're signing the next big one, which I'll talk about again in a couple of minutes. But the ability to create a diversified portfolio is something that we take a lot of pride on. So we don't have it as a fund. We don't sort of like subjugate your capital to how it is that we do, but we offer you all those opportunities and you create yourself certain locations, geographies, and certain strategies. So let's take a look at what does it mean for Astor to generate 23.2% return on an annualized basis versus, let's say, REITs. If you look at all REITs and focus primarily on the residential REITs, Alex pulled up information. If you look at the last, call it 30 years, right? You're looking at 12.7% annual return. Not too bad. There's obviously liquidity. There's benefits to work with the REITs. Some REITs have done better. Some REITs have done a lot worse. But overall, if you look at it, 12.7% return. If you look at the S&P 500, over the course of 75 years, ever since we started counting, the end of 2023, average return is 10.26. Obviously, there were some years, I wouldn't even say as much as some decades, that if you invested, then you couldn't come out of those decades without coming up with a loss. But the overall, right, the overall have generated that type of a return. Again, liquidity is very important as well. And so Astor is sort of like, if you compare us pound for pound, and not necessarily that you can, but if you put us like side by side, I would say that working with a group like Astor provides a very healthy and a very balanced portfolio. We outperform, obviously, both of these sectors, both the S&P and of course the REIT market. Let's take a look at what we've done 2023, or kind of like up to the beginning of this year. We've entered the market, we've entered 2024 with 3.8 million square feet. We've increased by 750,000 square feet our portfolio. Number of units have increased by 526. We've started with 19 active transactions, investments. End of the year with 22, an increase of 3. And so total active investments have engrossed up by another $38 million. Exited, right? We've had total exited beginning of the year 11. By the end of the year, we had 16, an increase of 5 different exits. If you look at the overall 2024, and I'm referring to the bottom portion. If you look at the overall in 2024, total exit, both principal and profits, were $16.6 million. Now, here's something very interesting. In 2025, the amount of exits that we're expecting is around 83.8, almost $84 million. So we're expecting 2025 to be a stellar year. Multiple projects that we're going to be exiting from. We started slowly going through doing your sort of like portfolio to see how many exits are actually coming up. But that's going to be a mega year. That's going to be a year that we're going to be generating, God bless and God willing, $42 million. Over $42 million is what we're projecting to generate in 2025. Okay, $41 million in, $42 million out, 83, almost $84 million expected to come back to you, our investors. What does it mean? It means you're going to have great possibility to reinvest, hopefully again with us. Many of you have, but certainly we're looking into those years. So the team over the last couple of months have started to putting together portfolios and to see exactly what sort of exits we're having, with whom, and to have you folks start preparing for it. But certainly, you know, the saying, stay alive till 2025, you know, it certainly looks like that's going to be a stellar year. So it's just sort of like a overall where we are from inception, all of the various spots that we are across the United States. You can see the various cities, you know, where we are, where we see activities by locations, right? There's a lot of activities in New York. We have from inception 25 different projects, the amount of dollars, you know, this will be made available to everybody who wants to take a look at. But again, a lot of our focus is specifically New York, in certain pockets of New York, certain pockets of South Florida. We spoke a lot about this. As I mentioned, we've exited from Illinois. We have a project still in Texas, Arizona, Columbus, Ohio, and New Jersey, right? So we see opportunities in those markets. In terms of origination, we haven't seen the typical of origination that we've seen in the stronger years, right? So overall, we see somewhere in the vicinity of about 600 to 700 different transactions, different requests. And, you know, the market is much slower. It's not 2020, 21, it's not 2018, 2019. It's a slower market, but still we're close to about 400 transactions that we've reviewed, analyzed, looked at, and gave it sort of like our opinion about those deals. Those that know us know that we say no to about 98% of all the projects that we see. So we have all the breakdown, and then I like to share it sometimes, you know, with you, our investors. Here are some of the projects that we have completed this year. We refinanced an existing development site in Harlem, generating to you, our investors, a net return of 12%. A Spice Loft, we had actually it's a much higher return, Alex, because it was supposed to be generating 15, but in Spice Loft, we had a very short preferred equity. Those that have entered with us to the project, we've had a minimum return, and so because it was so compressed, the time frame to do the Spice Loft preferred equity was so compressed, I think it was like 4 months. Our investors ended up walking away with somewhere in the upper 20% return just because of the duration. Celeste Midtown, many of you here participated in Celeste Midtown. It's moving well, a couple of months away from calling the second tranche. Atlantic was the first preferred structure that we came in and we created with Joel Schwartz and Eastside Flooring that is designed in such a way to actually make payments along the way. The previous ones, those of you who participated in Maker, pays once a year. But because we have a partner that has such a heavy cash flow, God bless, $17 million a year. We've analyzed the whole thing. I'm not going to go too much into it. $17 million a year, mega portfolio, $2 billion portfolio. We were able to negotiate cash flow and distribute it over to you on a quarterly basis, creating a stream of cash flow between 16 to 18% return. The deviation is 16 to 18, essentially is really depends on how much and how consistent you have been investing with Astor. Almost identical project in Fulton, where we raised $6.7 million. You know, analyze it exactly the same way. Celeste Reserve is a project that we're sort of like summing up the end of the year with. Again, the same group as the Celeste Midtown, and pretty much a very similar project, right? Where the analysis is people don't want to continue paying insane amount of money for rents every month. They want to be close to major employment, but they don't want to continue paying such crazy rent, 6,000, 7,000, 12,000, you name it. There's no end. And how much rent people can pay here in Miami. If I'll tell you, we look sometimes at complexes, and we see $35,000 a month for a 3-bedroom apartment, some luxury build. There's just no end. So we like to build for that sort of like, luxury, mid-luxury, affordable luxury, as we call it, market for the young professionals who enjoy access to transportation, everything else that's important to them. And it's actually, it feels great. It actually feels really great because it feels like we're doing something very, very positive. If you think about the last 4 projects, all of them have a very positive social impact, very, very positive social impact. The first 2 are actually designed for the affordable part of New York. We're creating gorgeous accommodation for families that are running into all sorts of issues, all sorts of financial issues and social issues and so on and whatnot. We've gotten amazing tax abatements. It's a great project. And you know what, you do good by doing well. We're making great money, but we're also doing something that has a very meaningful social impact. And I'd like to say the other 2, the ones we're doing here in South Florida, in Miami, the greater Miami area, same thing. We're offering wonderful accommodations, and we're doing it on a budget. Our average, I think, apartment is about 2850. So it feels good. Again, a picture of some of the deals we've done and invested in, and actually some of them exited. You can see over here, various locations. So it looks pretty good. Alex, I'll give it over to you to talk a little bit about our portfolio update, please.
Okay, yeah, absolutely. So the next few slides are mainly a summary of our existing portfolio. Some of them you've seen the pictures throughout the presentation already. We have the Caesars Scottsdale Republic on the left-hand side. And again, what we're trying to achieve here is to just remind you of which projects we have, when we entered them, what the cost was, the appraised value, and then provide you with some of the major updates for these projects. So this investment here, the Caesars Republic, we've entered in June of 2022. The project cost was right around $110 million. It recently, as Joe mentioned earlier, was appraised for $206 million. Joe also mentioned that the grand opening was earlier this year in Q1. And one of the main things that we're really proud of is that the food and beverages section of that hotel is really outperforming the initial projections by quite some margin. We have a new partnership with Hilton, which took place right after Thanksgiving. So that is up and running. We have a ton of events now because Arizona is sort of counter-cyclical to, I guess, the rest of the United States, where the good months are actually the winter months and the hot months are actually the slow months. So right now is actually the booming time for this project, and we're planning on refinancing it in the first half of 2025. To the right here, you'll see our cold storage facility, or I guess black sheep here in our portfolio, is the first industrial project that we've done. Actually very proud of this project also.
I wouldn't call it the black sheep. That's a bad connotation. This is a great project.
Oh yeah, actually, but it is an outlier. Certainly, it's also not the prettiest project, but it is one of the ones we have.
But it's an amazing project. Yes, go ahead.
It's an amazing project. We have a very great partner in this project. Stayed under the budget and entered this in 2022 in March. We just recently secured a long-term tenant after having that tenant for a short period of time, and we've outperformed the rents by over 8% versus our projections. The timeline now is a little bit stretched with this project versus our underwritings, but we are achieving greater returns because of that higher rent projection. Next projects that we have here, just an insight into our Brooklyn portfolio. We have 2 condominium projects that are going very well. One is in Boerum Hill on Bergen Street. We have 105 units. We entered that project in 2021, and the project cost 160. So we're generating about $100 million in profit from the projected sellout. And we're anticipating a Q1 TCO. And so far, we've actually had more than 40% in pre-sale. So the first $85 million worth of units are actually already in contract. So that's very positive news for this project here also. The other condominium project that we have here in Brooklyn that I wanted to mention and highlight is our First Avenue U project. So many of you are in either one of the Avenue U projects. We have two with the same developer. This is the first one and had 12 units. Again, March 2022, we entered. We're projecting right now a very healthy profit here, as you can see the spread between the cost and the value. We're anticipating also April of 2025 for the TCO. We already have 5 units in contract plus 1 in negotiation. So we're right around half of the units either in contract or serious negotiation. And that alone is enough to take out the construction loan. So very positive news on that end. We're actually outperforming the price per square feet by a very healthy margin. We've originally underwritten $1,500 per square feet, and we're achieving, north of $2,400 on certain units. I think $2,400 was even a unit that went for $7 million. So not only was it high on the price per square feet, but it's also very high in terms of the overall dollar amount. Moving forward, 2 of our multifamily projects. We have one in New Rochelle. We entered that one in October of 21. We had a brownfield tax credit here, so net adjusted, the cost was $60.5 million. And we're also very happy with this project. We're fully stabilized at this point, between 95 and 97% occupancy. And we're in negotiations for a refinance. So very close in exiting this project. We're hoping to be exited with this refinance. We hold a pref position in this. Yep, I think we skipped one slide. Next up is the Dania Beach Elevate project. Yeah, is 293 units. We entered it in the beginning of 2021. We had a slight budget overrun here, but we've also increased the rents by 50% compared to what we've initially projected. So, there was a nice offset in, I guess, valuation, despite the higher project cost here. We've achieved a TCO in August of 2024. So also that was slightly behind schedule. However, we're renting at a very rapid pace. We have Greystar as our management company, a very, I think at this point also globally known management company. And we're nearly 50% leased through December of 2024. So right now, roughly 50%. So actually going very, very well, while also implementing very high tenant standards as well. So leasing up at a very good pace for this project.
So those 2 projects we completed this year. One of them earlier in the year is already 97%, even higher, 90%, over 97% occupied. The one in New Rochelle, the one in Dania, it was TCO'd in the summers. We're very happy with both projects. Worth noting, we're preferred equity positions in both of those situations. And so when a project goes a little bit longer, or when a project goes a little bit more expensive, we're accelerated, right? Our return is fixed, right? In this particular case, on the right side in Dania Beach, it's an amazing project. It actually also fits exactly the same description. We want to be close to the very expensive area, but a little bit out so we can offer great discounts. This one is a little bit over $3,000, $3,200, $3,300 on an average unit. A gorgeous, gorgeous project. So we are either going to be exiting from this project in April of next year, or we might extend for 1 more year. Now we have a clause that if we do extend for 1 more year, our return jumps from 18% to 24%. And, of course, we'll consider that. But ultimately, it's not the worst thing to sit on a gorgeous building that is stabilized, increasing in value, and generating for us at that stage, right? Remember, it's always risk rewards at this stage. If the developer wants to keep it for 1 more year, and position sale, not in 2025, position sale one more year out, we'll enjoy the benefit just like everybody else. So we'll move away from 18% to 24% in this particular project. On the one on the left, in New Rochelle, again, I mean, they've done a phenomenal job. They built it super quick. And ultimately, we're looking at the refinance. So we expect to exit this project sometime in the later part of this year. We have a very big bonus. It's called the Brownstone tax credits. Our investors will benefit from that. I expect to achieve our investors also very, very high teens on both of those projects. Let's move on to the other ones.
Yep. So
let me take this on. I'll do it very quickly. So 2505, we have 42 units. We have 2 units left. This is not a project we're very happy with. The building looks amazing. Upper West Side of Manhattan. It took a while to sell. The units moved extremely, extremely quickly, extremely slow. We hit everything on this project. I expect the returns on this one to be mediocre, very, very low. Possibly even low single digit returns on this one on the right. I would say the same thing goes on this one on the right, the Conover. Same thing. We're not going to see large returns. Going to be low returns in those two projects. They straggled through the Corona. They struggled through. Both has only 2 units left to sell. We're out of the woods. We're out of the risk, right? We're finished with the loans on both of these projects because, the longer the project works, basically the interest rate on the construction loan chew away a lot of the profits, and that's something that happened to both of those projects. Again, so not everything is stellar. Sometimes things go a little bit longer. Sometimes things go a little bit wider on the right side. There was some issues with the contract. We have to step in, move the contractor, our operating partner, finish the project by himself, replace the individuals. That caused some delays. The one on the left, simply the market didn't quite stand. The one on the left, I'm talking about 2505 on the Upper West Side, the market became very, very soft. A neighborhood which was really paved in gold prior to the Corona have gotten hit severely with all sorts of socioeconomical issues. And then we're feeling the effect on those. So those are not great projects, and we're certainly looking to say goodbye to them sometimes in next year. Before I go to this project, the other two projects, we also have another project that doesn't appear here. We have another project called the Legacy Project. The Legacy Project is a tower that we're also taking a preferred equity position. It's a tower. It's a 50-story tower in downtown Miami. It's a gorgeous building. It's a 1,000,000 square feet building. We've entered this project when the 310 condo units were 95% under contract. There's an office component in there. It was 70% leased. And then there was a hotel component in the middle, the SLS Hotel. The project has now been stalled and it's been sort of like on the side, stalled for now more than a year. We are preferred equity. So we're accelerated. And the operating partner, our developing partner, is now in talks, now very, very late stage talks to replace the current loan, to put a new loan and continue. What works for him is the fact that the market has improved significantly. The hotels, in fact, is going to turn into more condo units. It's going to be condo hotels. It's going to be a very successful project. There's been an appraisal that went on the asset of late. It's extremely, extremely valuable. But that year or year plus of stall project has been very uncomfortable to all of us. We're negotiating. We're very, very close to the entire operation over there. We're negotiating an early exit. We were able to get a signature on an early exit. We want out of this project. And in January, we're going to sit down again. We're going to find a way to get out of the project even sooner, even though the kind of like on parameters, we're still supposed to be there. We simply don't want to be part of that project. And we have good reason. We sort of like saw the problems a little bit ahead of time. There were some issues, and we decided that this is not something we want to have. Now, the fact that we have very strong legal position over there, that we can cause issues, we decided not to cause issues. We're not going to be the one to cause this project to fail. but we're certainly negotiating a way out. So ultimately, I don't have much concern to our capital because, the valuation of a project, the amount of debt that we have on the project is very, very low. It's only $30 million over $180 million that was spent. At this point, actually close to $200 million spent, and the debt is very, very low, only $30 million. So we have plenty of meat over there, but we just don't want to take any part in projects that are not moving and are not grooving as they should. And so there's some challenges, as I said, but again, we negotiate, we step in, we do what we need to do. We're not trying to cause any situation. Obviously, we can always start with the legal, but we understand that the developer is in a mess. The developer is working whatever he can to work it out. There's a good line of communication. We're there. We're sitting down with them a lot. We understand. We're speaking to their banks. We're speaking to everybody. We're letting the process take its course so we can all exit naturally, and wish them great luck to continue and making tons of money on those projects. So again, why we look for diversification? Because things can go sideways. If you have a good amount, it doesn't matter if you have $100,000, if you have $5 million, create diversifications. Things can happen along the way that can delay things. Things can get a little bit longer. Obviously, when we're negotiating projects internally, when we are looking at a project, we always want to make sure that we have a good base, that there's always a fallback scenario. We do the exact same on the legal side. Our attorneys are very, very strong and very aggressive. I would even say the word aggressive when it comes down to negotiation. So when we negotiate terms, we keep it in such a way that we have the upper hand should something happen. All right, very quickly, I'm going to skip through those. We've had a number of rollovers, those that are in the Meekers. There's been a rollover this year from Meeker to North 7th Street. I want to acknowledge my friend Susan. Susan is visiting our project in Brooklyn. She's a good friend of ours from one of the organizations that we're members of, and she goes there on her way to family. She stops by in some of the projects. She takes some pictures, and she's on top of it, and that certainly helps us a lot. Obviously, we get all the information from the developers, and we have our calls, our scheduled calls, and we send our people to check as well. But if any of you want to help out, and if there's a project that you're involved in, you're invested in, and you want to help out and send us pictures because you live close by and you go there on a weekly basis or something along those lines, by all means. Susan is the first one, I think, to do that, and I'd like to acknowledge you, Susan, for doing that. It's very great of you. Consequently, within the next couple of weeks or so, the Gold Street project is patriating capital. We're exiting imminently, right? So those of you that are in the Gold Street project, the one on the right side, we're exiting imminently. More exits doesn't happen this year. We finally finished with the project on St. Mark's. It's been a very beautiful project, stellar project. And the last unit, we had 100 apartments, stellar project, $177 million sale. The last unit, the retail unit, lingered. So while our investors got all their money back and made an amazing return, we had the last unit lingering. Eventually, the developer himself came, and we negotiated to sell the unit to him. He bought the supermarket. It was a grocery supermarket. And then we decided to just exit this project. It would happen this year. And as I mentioned earlier, Church Street in Flemington, we've taken a position, a short-term position for 9 months to do some sort of a bridge, a mezzanine bridge. Those of you that have participated with us, I think we stayed in the deal for maybe 6 months, maybe less than 6 months. And so the returns were actually, IRR was much, much higher than we'd have anticipated. It wasn't 15%. It was significantly higher just because of the short duration. Finally, we are still at the final stage of raising for Davy. This is the project that we've mentioned. It generates between 21 to 24%, 350 units right here in South Florida, with the very same group that we've mentioned before. If you're interested, we still have a few units left. We decided also to split it up, which means that we'll take half the money now, the other half in about 6 months down the line. What does it mean? If you're investing 100 or $200,000, you'll put 100,000 now and 100,000 at the back end 6 months down the line. Ultimately, it generates better return. We negotiated this very recently. This is a decision that we decided to do about a week ago. The bank wants to close now. And so there's no point of putting all of this capital, all of this equity to put it on the sidelines. So we can do it in two tranches. To you, the investors, that actually generates a little bit higher returns. If you're in the core group, which is investors under $250,000, your return is moving away from 21% to around 22.5. If you're select 250 or up to $1 million, your return has moved closer to 24%, and your premier group, you're now are looking at around 26%, just a little bit over 26% a year. That's as far as those projects go, and I think we're at the end of the presentation. So we're 8 minutes before the full 1 hour presentation. Please reach me if you have any questions. As I said, Alex and the rest of the team are working right now on your portfolios. We're putting together an amazing presentation to each and every one of you. Some of you have 15, 25 projects, 22 projects with us, and we have an entire way to show you, sort of like broken down, break it down between when's your exit coming, how much of an exit, what's your average returns. They're working very hard in putting all of this together, and ultimately we're working with a group to make sure that it's very much on an ongoing basis, so we can offer you those things quarterly or semi-annually. I want to wish us all fantastic holidays, and I want to wish you all great time with your loved ones and your families. If you're traveling, please be safe. And I truly inspired by all of us. Even though we started the second half of the year, it's been a stellar year for us. You backed us up with your trust, with your support. You came through for us. You brought your friends. You made recommendations. And we're truly inspired by all of this. I want to wish you all happy holidays. Please reach me with any questions. Laura is less available. Damon is here, and the rest of the team is here. Laura will come back sometime around March, late March. We want to give her the time, but she is helping out. She's an amazing lady. She's helping out, and I know that some of you sometimes have specific questions, and she helps out. But she's got her hands full, right? Two gorgeous babies. Thank you very much, everyone, on behalf of Astor Realty Capital, for the support, for the trust, and all of us have a fantastic 2025.